Today we're going to talk about the four main business forms or forms of business organizations. But before we get to that, if you were starting a business and trying to determine what type of business form you wanted to use, what factors would you consider? Well, first you would need to think about the creation of the business form. How difficult would it be? Are there specific forms or papers that have to be filed somewhere? So that would be one factor. You would want to think about the duration of the business. Is this a short-term venture, or is this something that you want to last in perpetuity? Then you would need to think about which organizations or business forms would allow that to occur. Think about control. How much control do you want to have? Do you want to share it with partners? Do you want to have a board that oversees everything? Then think about taxes. Would it be more beneficial to you to have profits taxed as personal income or to have them taxed at the entity level? Then think about liability. How much protection from liability do you want? And then lastly, think about capitalization. How much is it going to cost to start the business? Where are you going to get the money to create it? Those would be the things that you'd want to think about. Now, by far the easiest business form to create is the sole proprietorship. It is a business that is owned or operated by one person. It is easy to create and close. There are no formal documents that have to be filled out or filed anywhere. The downside to the sole proprietorship is that you have unlimited personal liability. So if you were to be sued in the course of your business, not only would the business assets be at stake, but so would your personal assets, your own home, your car, your bank accounts. Of course, you would have some insurance to hopefully offset some of that liability, but still that risk is out there. With the sole proprietorship, profits are taxed as personal income, and you would just report that on Schedule C of your tax return. The second type of business form is a partnership. A partnership is created anytime two or more people carry on a business for profit. The partners are entitled to share in the management of the business. They're entitled to share in the profits of the business and in the liability of the business. There's no requirement that you have a written express partnership agreement. And if you don't have one of those written agreements, then there's something called the Uniform Partnership Act, or in some states the Revised Uniform Partnership Act, that is going to set out some basic rules that would apply to the partnership. One of those basic rules or basic assumptions is that everything is going to be shared equally. So profits, liability, management would all be shared equally. If you don't want that to be the case, then you would need to get a written partnership agreement that says otherwise. In the partnership, all partners have a right to participate in some level in the management, again, to share in the profits, losses, and assets of the business. They have a right to inspect the books and see how much money is coming in and what is going out. They also have a right to demand an accounting from the other partners and hold them accountable for their use of partnership assets. Just like a sole proprietorship, profits from the partnership are going to be taxed as personal income. The partners owe a certain fiduciary duty to the partnership. It's a relationship of trust, and so those partners are expected to act with care, reasonable care, as they conduct business for the partnership. And they're also expected to be loyal to the partnership, so they can't go off and engage in self-dealing that would be profitable to them but harmful to the partnership. That would violate the duty of loyalty. As far as authority goes, generally any partner acting individually can bind the partnership. They can enter into agreements or deals on behalf of the partnership, and that just goes back to agency principles. Partners are considered to be agents of the partnership. As far as liability, the partners are jointly liable for debts of the business, and that includes torts that occur within the course and scope of the business. As far as terminating a partnership, there's a dissolution and winding down process that has to occur. Notice has to be given to any creditors, debts have to be paid, and then the remaining assets can be sold or distributed to the partners. Two special types of partnerships are limited liability partnerships and limited partnerships. A limited liability partnership, or LLP, allows pass-through taxation, so the profits are taxed as personal income, but it allows the partners to avoid personal liability. Similarly, a limited partnership, or LP, allows some of the partners to avoid or limit their liability. With the limited partnership, there has to be at least one general partner, and that general partner is responsible for the day-to-day management of the business, and the general partner assumes unlimited personal liability for the debts of the business. Now, one way that people will try to get around that is by making a corporation be the general partner, because the corporation, of course, has a limited liability. Within the limited partnership, there are some limited partners. They are not permitted to participate in management, and in exchange for that, they get limited liability. It is limited to the amount of money or investment that they have made in the partnership. Third type of business form, and really one of the most popular business forms today, is the limited liability company, or LLC. An LLC is formed by filing an Articles of Organization with the Secretary of State's office, and those Articles of Organization are going to outline the purposes of the business and provide other information that is required by law. The LLC is kind of a best of both worlds. It's a hybrid of corporations and partnerships, because the income is taxed like a partnership, but you get limited liability like a corporation. The LLC can be set up to be managed by members. Each member may own a certain percentage of the LLC, and they would be responsible together for managing the LLC. Or you can hire a manager who manages the company. And really the issue goes back to agency and who has the authority to bind the company. If it's member managed, those members would have that authority. If it's manager managed, then the manager would have that authority. One good reason to have an operating agreement in addition to your Articles of Organization is that in that operating agreement you can lay out who is going to be responsible for what tasks and so forth, very similar to a partnership agreement. Now I want to say a few words about corporations. The first step in creating a corporation is to select the state of incorporation. Where do you want it to be incorporated? Then select a corporate name, and that name has to be approved by the state to make sure that there's no other company in the state that has taken that name. And once you have that, then you're ready to prepare your Articles of Incorporation, which is a document that is filed with the Secretary of State's office. The articles are usually going to give the corporation's name, the number of shares of stock that it will issue, as well as the name and address of the registered agent, which the registered agent is the person who is authorized to receive legal documents on behalf of the corporation. Once you have your Articles of Incorporation, you're ready to file those, and once they have been filed, you can have your first organizational meeting at which the Board of Directors will adopt some bylaws, and those bylaws are just internal rules of management that govern how the corporation will operate. Shareholders enjoy limited liability. However, in some circumstances, courts have allowed that limited liability to be taken away through something called piercing the corporate veil. That can occur if a party has been tricked or misled into dealing with the corporation rather than an individual, or if the corporation was never really set up to make a profit or to always be insolvent, or if statutory formalities have not been followed, or if personal and corporate interests are commingled to such an extent that the corporation really doesn't have its own separate identity. But what are the rights of the shareholders? Well, the shareholders have the rights to elect and remove directors from the board of directors. They have voting rights, especially anytime there's going to be a major change to the corporation that might have to be approved by the shareholders. They have a right to receive dividends in proportion to the amount of stock that they own. And they may have preemptive rights. If new stock is being issued, they sort of get first dibs on purchasing that new stock. The powers of the corporation are going to be laid out in the Articles of Incorporation. And the board of directors, again, it's a fiduciary relationship. They owe a duty of care and loyalty to the corporation, so they have to use reasonable care when acting for the corporation. They have to be loyal. They can't engage in self-dealing that is profitable to them but would harm the corporation. The board can be liable if it acts negligently, and the board has to act together as a unit to bind the corporation. So you can't have one member of the board go rogue and bind the corporation to some contract. The board has to act together as a whole. The officers of the corporation, this would be like the CEO and the chief financial officer, the chief operating officer, those people who are responsible for the day-to-day management of the corporation. They do have the power to bind the corporation. Again, going back to agency law, they are agents of the corporation, and so they can enter into contracts and agreements on behalf of the corporation. They can also be held liable for any negligent acts they commit in the course and scope of employment. I do want to note just briefly some special types of corporations that are discussed in the text. Closely held corporations, that is usually a family business that is incorporated and it's not traded publicly. You couldn't go on the stock exchange and buy shares in a closely held corporation. Non-profit corporations, you're probably familiar with. This would be like the American Red Cross and things like that are set up for non-profit purposes. There are also professional corporations, or PCs, and you'll usually see that with members of a profession. For instance, a group of accountants or attorneys or doctors. And the last special type of corporation I'll mention is the Subchapter S corporation. That refers to Subchapter S of the Internal Revenue Code. This is something that a smaller corporation can elect, and the reason they would elect it is that they get some more favorable tax treatment.